Okay, so when you were talking about the housing market or the 30-year, it's the 30-year mortgage rate loan, you said that it's reached a percentage that's higher than it was in 2007, 2008 period.
Right. Yes. So the 30-year fixed mortgage is actually the national average is 7.4% as of today. That would be August 18th. And yeah, we just haven't seen it. It's because of the historic rate raising campaign, but it's been creeping up over this last few weeks here, even after the Fed meeting where they did hike interest rates by a quarter point, but the interest rates ever since then have been continuously going up. And why that happens is markets are preemptive. They're gonna do things before they actually take place. So if the markets are expecting the Fed to do another rate hike, they're going to preemptively, the interest rates are going to go up, and that's what we've been seeing. So the expectation for equity markets, the stock market, is the Fed isn't going to hike rates at the next meeting, or possibly again, and then the bond market, which is the institutions, your CEOs, your pension funds, Ivy League pension funds, they're the ones that are trading the interest rate markets. They have the insights to the politicians. They have a lot more knowledge than your average retail trader trading the equity markets. So they're signaling the rate hikes are coming again in the future. So again, the market's preemptive. It's rising before they actually raise rates. So it's putting a real strain on the housing market. And again, the rates are very high, higher than they were in 2006, 2007, 2008. And at the same time, housing prices haven't come down. So you have both interest rates and housing prices very high. So one of them's got to give for this equilibrium and this balance to take place back in the housing market. And we're leaning more on the sides of the housing prices are going to come down first before rates come down, because the Fed has already said over and over again that their main concern is inflation, the fight against inflation.
Okay, so let's slow down. So let's say I'm someone in my 30s and I've been saving up a lot of money to buy a house. You're saying that I should wait, but not wait like soon. Like I should wait it out like a while, like, because it's just not the right time to buy a house because the interest rates are really high and the prices of houses are really high.
That's a great conversation that I've had with a lot of my clients. And then, I think you got to look at it two ways. So is this for investment purposes, or is this for like family and personal happiness? And I think if it's like for family, personal happiness, it's not an investment. I want to take my family and we want to expand, or hey, I want to start a family, or maybe I even want to downgrade because I have too big of a house, and so therefore I got to buy a new one. And that's a long-term deal, 10, 20, 30 years. That's personal happiness. Always support that. You're not trying to make money with it's not like an investment. It's actually an expense. It's a liability that you're adding to your asset base, or it's not really an asset, it's your liability, but I guess you'd say your personal balance sheet. Now, if you're looking at it from an investment perspective, given that interest rates are at all-time highs, I mean, the highest we've seen in really like 23 years, and housing prices again are really, really high, but they are coming down. We're seeing them come down. We're seeing places where inventory can come from, short-term rentals. Home builders really shot their home building completions up in the month of July, also their starts of new home builds. So that inventory is going to come to fruition. And then vacant and unoccupied houses. So there's a lot of places inventory could come from. Doesn't mean that it's actually going to take place, but as housing prices come down, you get headlines, people start feeling emotional, like, oh shoot, maybe I should just sell. That can create that spiral effect of more and more inventory, and then more and more sales, bringing housing prices down, and then interest rates can remain high, and there will be kind of this balance and equilibrium. And then at some point in the future, if the economy starts to get shaky, Fed cuts rates, and we're back to a more normal real estate market, back to pre-COVID.